Hello, this is Mike Swanson of WallStreetWindow.com. I've got a very special guest with me today. I'm speaking with Ike Iosif, runs the website MarketViews.tv. How you doing today, Ike?
I'm doing good, Mike. Thank you.
Well, this is a follow-up interview to really what was part one, in which you really emphasized the point that there's a dichotomy that's very unusual going on with bonds and stocks, almost an anomaly. They're trading both together for what's becoming a long amount of time. I'm curious, we're going to really get into this and talk about the implications of it, but how do you explain it yourself? What do you think is going on?
If we look at the first couple of charts, what we see here, Mike, is that we have the monthly chart for the yield on the 10-year bond and the monthly chart of the S&P. In 2000 and again in 2008, we saw the S&P and the yield on the 10-year Treasury bond falling below their 22-month moving average. That is a long-term average, and usually it does indicate a change in the long-term trend. In 2016, we saw the yield on the 10-year bond falling below its 22 moving average, but for the S&P it only happened twice, very briefly, and then the market went up. What happened in 2016? Well, I would like to remind people if they have forgotten, and I have three articles, two from February 10th of 2016 and one from March 15th of 2016. What happened was the Fed got scared from the decline that we had in 2015-2016, and just like now, back then it announced that there would be no more further rate increases. At the same time, the ECB cut interest rates to zero. The market got also a boost of liquidity in the neighborhood of about $5.5 trillion from the world's central banks. That's quite a bit of liquidity.
Yeah, I remember Japan getting involved in it too. It was very coordinated.
Yeah, it was. We're talking about, if I'm not mistaken, either $5 or $5.5 trillion in liquidity worldwide. So the market went straight up. So now let's move forward to today, which is the chart to the right. We can see that the structure looks similar to what we had at the bottom in 2016. My explanation here is that it seems to me equity investors are betting on a repeat of what happened after 2016. In other words, I believe equity investors are betting right here that the Fed got scared, capitulated, and therefore the path is clear to the upside. On that, I think we need to look at a few more other things. The next chart that I have is the US unemployment rate. We can see that back in 2016, the unemployment rate was at 5%. Now it's at 3.8%. The next chart is the US employment cost index. We can see that it has been rising. The next chart is the US living wage. We can see that it has also been rising. My good friend Mr. Jim Goss for smartportfolios.com posted a brief but enlightening note regarding the average hourly earnings and why they will not stay muted. So my point here is this: when you put all together, some of the macro data are not the same as they were back in 2016. Let's take a look at the next chart, which is the weekly leading index from ECRI. We can see that we had a pretty sharp upturn during the first quarter of the year. If we look at the next chart, going back to 1969, we can see how it has gone above the zero line. Now, we did an interview, you and I, on February the 2nd of this year.
Yeah, that's right. We were talking about the bond market back then, just as this dichotomy was starting.
Well, at the time, I had said that there are 5 probable scenarios for bonds, and there lies the risk. When you have the 2 scenarios to deal with, then the probability that one of them will play out is a lot higher. But when you're dealing with 5 different scenarios, that's a whole different story. I mean, the chart on the left is the scenario that we had posted back on February 2nd.
Okay.
And the chart to the right is the actual price since then. Now, if you look at chart 1, the scenario 1 and the actual price action, it looks like this scenario is still in play. We move to scenario 2, that looks, it's still in play. We can't exclude that out
that
either.
can happen.
Then we move on to scenario 3, that could still be in play, and so does scenario 4 and scenario 5. In other words, all these different scenarios are still in play, so the risk of miscalculation is quite high.
Well, one of my favorite things that you do and you share with your subscribers regularly is your inflow-outflow analysis of gold stocks and also the S&P 500. What are they showing right now? Actually, might be good for people who don't know. Maybe explain quickly what.
Yes, what it is, Mike. It's a kind of a different measure of volume. We're not measuring just volume. What I'm measuring is dollar volume. And let me explain in plain terms what I mean. Let's say somebody buys 1,000 shares of XYZ stock at $1 per share. The total value of the transaction is $1,000, right? Somebody else buys 1,000 shares of another stock at $500 per share. The value of that trade is $500,000, correct?
Right.
But both of them are 1,000 share trades. Looking strictly at volume, if the first trade was on the upside and the other trade was on the downside, net, the effect on cumulative volume is 0. But when you look at the dollar volume, if the first trade was on the upside, we're talking about plus $1,000. The other one is minus $500,000. In my view, dollar volume is more accurate than just volume alone. So what this indicator does, it looks at dollar volume. What it tells you is what the inflows or outflows are right now. What it doesn't tell you, and I want to emphasize this, is if for some reasons are going to change tomorrow. The assumption here is that the picture that we're seeing will continue. If that continues, then this will happen. If something happens, some exogenous event that changes the market dynamics, then of course we have to look at what it's telling us at that particular time. We can see that for the last 2 months, we have had a negative divergence. I can extrapolate that if this was to continue, we would get a negative crossover by the time the S&P gets about 3,010.
And the last time that happened looks like it was right after the end of September.
Yes. So between 2950 and 3050, if this was to continue, then I would look for a reversal in the market. It could very well be that we get a trade deal with China and everybody gets excited, we get a new way of buying. What I'm saying is based on this continuing in the direction it's going right now. Obviously, the reason we update our reports is because if something changes, we do change our outlook accordingly. So I would pay attention to the 2950, 3010, 3050 area for a potential reversal.
Most people, frankly, that at least that I get emails from, are very bullish on the market. And I don't think they're looking for a peak at those levels. Some people, I think they think we could just go on some giant blow off. So let's assume the negative crossover doesn't happen. How high could things go then?
If that doesn't happen, extrapolating from similar structure in the past, we would have additional gains anywhere between 6 to 10%. However, let's say it did happen. I would like to examine the context in which it will happen, okay? The next chart is the total stock market capitalization to GDP. We can see that it has exceeded the 1 in 2000. And the next chart is the non-financial market capitalization relative to non-financial corporate gross value. And we can see that by this measure of valuation, we are at the second highest record in history. The point here is this. Yes, we could get a blow-off. In fact, blow-offs occur when the market is highly overvalued and just simply gets more overvalued. It could easily happen. It's not impossible. The point that we need to keep in mind is this. The price actions in December, since the December low, suggests that equity investors are betting on a repeat of what followed the 2015-2016 decline. Mm-hmm. A repeat of that would mean a blow-off move. Could it happen? Yes, it could. But back from 2016 to 2018, we got a 63% rally from the low to the high.
And thinking, tell me if I'm right or wrong here, but let's say a blow-off move does happen. Okay, just by the way the charts look, that doesn't mean the market's going to go straight up tomorrow and up, right? These blow-offs usually get a pause, and kind of like last year, it paused and then broke out in September, or tried to. But anyway, what I really want to ask you is, if the blow-off were to happen, would your money flow indicators kind of warn of it or trade differently than if we just topped out at the lower level?
Well, what would happen is that, first of all, we would see a rebound at the equilibrium line. That's the first thing that would happen.
Okay.
Something that we really need to keep in mind here is this. What all these things are telling me, Mike, when I put together the charts, the macro, the fundamentals, put everything in context, is this. If there is a recession later this year or early next year, then equity investors will be surprised, and unpleasantly so. On the other hand, if there is no recession and instead the economy rebounds, then under the current macro circumstances, I think the Fed will find it hard to keep rates at current levels. Short term, speculative blow-off cannot be excluded out. However, what I would be pay attention to over the next few weeks is the 3010 level plus or minus 1 and 1.5%. If at that point we have a negative crossover, the S&P is about 3010, 3040, then to me that would be a very cautious sign. If the S&P blows through 3050, inflows are positive, then a blow-off move would be underway.
What do you think is going on with gold right now? Because we've had a pullback. It went up to 1350 and now, pulled back down the past couple of weeks, really, 6 or 8 weeks.
We did our last report on gold and gold stocks was on March the 4th. And at the time I gave out 2 scenarios. So both scenarios are still in play. They are still alive, although scenario 1 looks more probable than scenario 2. In this case, we will see a decline below 1260 as low as 1220, but actually that would be a buying opportunity for gold. So what I'm looking for, and I'm going to have the next report on gold out within the next 2 weeks, is to see a resolution, because like I said, right now we are at the demarcation point.
Well, it's going to be interesting to see how this all plays out.
Before we finish for today, there's one last thing that I would like to point out. This is something that people really need to pay attention to. I have made the next 2 charts up myself for the purpose of illustration. The chart that we're looking at right now, we'll call it XYZ 100 index. And let's say it represents the 100 biggest stocks in a major, mature, semi-efficient market like ours. We can see that at point A, the chart shows an inverted head and shoulders. Okay, so the market breaks out, moves up to the next level. At point B, once again, we have an inverted head and shoulders. The right shoulder is kind of truncated. Nevertheless, the market breaks out to the upside and we get to point C. If you just look at the chart, it's very easy to say another inverted head and shoulders formation. I'm going to buy this because we're going to have another breakout. let's look at the next chart. Let's say, and I want people to consider this, at point A, when we got the first breakout, the GDP was rising, the unemployment rate was falling, and the inflation was stable. At point B, once again, GDP was rising, the unemployment rate was falling, and the inflation was stable. But as we come to point C, and again, I'm making this up just for the purpose of illustration, this is not a reflection of the economy, of the U.S. economy. This time around, the third time, GDP was flat. The unemployment rate was rising, and the inflation was rising. Would it make sense to expect a break on the upside? Probably not. My point is this. The chart alone does not tell the whole truth. The chart alone is not the puzzle. It's a piece to the puzzle. It's not all of it. What I want people to get out of these two charts that I said I made them up for the purpose of illustration is that you cannot look at a chart alone out of context. You need to put the chart in context.
Thank you for taking the time to talk with me and everyone else.
My pleasure, Mike.